So Schroders Capital, we invest in the small to mid-cap part of the market, as I've said, and when you look at our returns versus listed and even private equity indices over a 15, 10, 5-year time horizon, you can see this more formulaic approach to investing has worked. So the light blue bars are the MSCI or Country World Index. Probably unsurprisingly, you're looking at those high single-digit returns if you invest in listed markets over 15, 10, 5 years. We've then got the Cambridge Associates Private Equity Index showing that private equity has indeed delivered a premium to listed markets looking backwards. And then the dark blue bars are our track record showing that small to mid-cap bias can consistently deliver a higher return than the average private equity return. But I know what you're all thinking, that's just because interest rates have been low for the last 10 to 15 years and private equity is over-levered. So of course you've outperformed listed markets. When you break down, though, how we've delivered returns over that period, so we've got from the sort of bridge chart on the right-hand side, for every dollar we've put into a direct company investment, on average we've returned $3.30 to investors just on exited investments. So there's no arguments here about, valuations or funny numbers. This is just a dollar in versus how much have we received back. And you can see the bulk of the return is through EBITDA growth. So this is finding interesting small companies, growing them, professionalising them, increasing their sales, moving them from, because 60 to 70% of the companies we buy in the smaller end of the market are previously family-owned businesses. So you think about it, I think some people conflate small with new. These companies have often been around for decades. They could be leaders in their particular field. But when you think about a founder-led business, very few founders are professionals across sales and marketing, operational efficiency, M&A. Maybe they haven't even had the capital if they wanted to expand into a surrounding geography. There can be, legislative or regulatory issues with that as well. So that's where private equity can really step in and help grow and professionalise that business and increase its sales. We have an interesting story. One of the portfolio managers was doing due diligence on a company and he said to them, "So how many do you have in your sales team?" And he said, "Oh, we don't have a sales team. People just call on the phone and put through the orders and we process them." So as a private equity investor, you're rubbing your hands together going, great, step one, put in place a sales team. And little things like this that I think really reduce the risk of companies and make it more about that, how can we operationally improve? How can we increase sales? What can we do that's not correlated to listed markets to drive returns for that company? So as you can see, that EBITDA growth is making up the bulk of the returns we have delivered through our track record. The second main factor is that multiple expansion. So that's coming back to that previous chart where we show the discount small to mid-cap companies trade at versus the price that someone will pay for a large cap private equity. So we're buying companies at lower multiples because they're smaller in size, growing them, professionalising them, and then selling them usually upmarket to a bigger private equity fund who'll pay you a higher multiple for that same company. So we call it buy low, sell high. We think it's a pretty good idea. We might patent it. But you can see that that has delivered returns through that orange multiple expansion bar. But importantly, we don't underwrite to that assumption. That's sort of like a nice windfall gain that we generally earn through these companies. But the most important part is you can see that debt component. That makes up a very small portion of how we've delivered returns historically. In the small to mid-cap part of the market, normally these businesses we invest into have a local bank relationship. As I'm sure you all know, banks tend to be more prudent in their lending arrangements, so the companies themselves have lower leverage, and additionally we prefer this bank form of financing to the big debt fund financing because the banks tend to be more forgiving, more comfortable to do a debt restructure or repayment holiday. We find those debt funds will put in lots and lots of turns of leverage into a company, but they can be pretty ruthless if anything goes wrong, even temporarily. So as I said, we're always looking for these companies where we can see a clear path to grow, professionalise, and then typically we don't even usually exit via IPO, so 90% of the time we're exiting our companies through sale to a corporate in that same sector or to a larger private equity fund. So our strategy additionally is not as reliant on the IPO market, which has been helpful over the last year or so.